Hey, Bowtie Nation. Joseph Hogue here. Thank you for joining us again for another one of these 3 p.m. live streams. Loving doing these. Get out to you a little bit more frequently here with the stock market news of the day. Tuesdays and Thursdays at 3 p.m. Eastern, kind of track what's happening in the markets, give you some back and forth there. And I love these. I love these face-to-faces we have here with these live streams that we just don't get with these other videos. So we're going to talk about a very important topic here lately to the community there, that MPW Medical Properties Trust. Is it done falling after that dividend cut they just announced yesterday? We're going to look at some of the price action today. Yesterday is very promising that it closed higher yesterday after that dividend cut announcement and has made back a lot of the losses today. It looked like a lot of the short sellers were coming back into the stock today to try to take another short position on it, but it appears there is a lot of buying interest propping up that stock again, buying in at these low valuations and after that dividend cut. So we're going to talk about that. We're going to talk about why I just bought 2,000 more shares yesterday, what I see in the stock. We're going to cover a couple other news events that I've been following here in the markets, and then get to your questions and answers. I love seeing everybody out there, from all over there in the Bowtie Nation. Let me know where you're coming from there. I see Nutty's Finest there, Matthew there, Joseph Flores. First time in a while. Good to see you there, buddy. But really excited to get started here. If you're new to the channel, don't forget to join the community by tapping that subscribe button so you get those notifications. Check out tomorrow's video. Got a great video tomorrow coming, how to tell if artificial intelligence is writing your stock analysis. Okay, we're already seeing the AI programs posting a lot of stock analysis used by these companies that just want to basically cut their writing costs and their analysis costs, posting this AI stock analysis online. I've seen it on Yahoo Finance a lot, and it's going to lose you a lot of money. So I wanted to give you some clues, some hints on how to tell whether AI is writing that stock analysis and if you should follow it or not. So again, join the community, tap that subscribe button, and be watching for that video tomorrow, 11:45 Eastern. Also in the chat there, I've posted a link to a 5-minute analysis guide. Now, this isn't all the analysis you need to do for a stock, but I put together a real quick win guide. 5 minutes, all it's going to take you to analyze any stock you're looking at. It's going to take you through some of the best metrics, some of the measures and financial things that you need to be looking for a stock before you invest in it. So now I want to get to the topic, though. Main topic today, MPW Medical Properties Trust. It is definitely a roller coaster, as someone there in the chat has said. Like I said, it is promising that yesterday they did announce a dividend cut finally. And the fact that the stock was higher on that dividend announcement then leads me to believe that obviously all of it was priced in. The market was fully pricing in the idea that that dividend was going to be cut. The thing though here is it was cut in half, which basically, in my market update video Monday morning before the market opens, then I talked about a 50% dividend cut. That's exactly where I thought it was going to come out at. But even that, at this price level, is still an 8.5% yield, which is huge for a real estate investment trust. So right now, it is still providing a very good dividend yield, 8.5%, and I believe very strong price appreciation up to a fair value of $13 once it works out some of the problems that we're going to talk about right now, right? So now one thing to consider here is, to kind of get an idea of whether this stock is done falling, whether the company is, past or will be moving past its financial troubles. Okay, obviously, just with a dividend cut isn't going to clear out this stock and start it going higher. It has to move through. It has to survive through a lot of these hurdles that it's seen here, over the last 2 years, right? Some of them as part of management, some of them part of just the larger real estate sector that we're going to talk about. But to consider here, they cut that dividend by 50%. That conserves $350 million in cash every year. Okay, the company was paying out about $700 million in cash to satisfy that dividend each year. It now has $350 million more in cash that it can use to survive, to prop up some of these other tenants that it's been buying equity in, that kind of thing. Add that to free cash flow. So cash flow after, you've got your operational cash flow from operations minus your maintenance capital spending, that kind of thing. That gives you your free cash flow. Free cash flow already was $700 million a year, and company should have all the financial flexibility it needs to survive. Okay, proceeds from recent sales were used to shore up the debt. I want to share another one. This is actually old. This is from December of last year, so the fourth quarter of last year. They showed their debt maturities out, and we saw they did have 4.7, about 5% of their total debt owed, total long-term debt owed there in this year, 2023. Got another 9% owed here in 2024, and a big chunk, 13%, 1.3 million or 1.3 billion there that's coming due in 2025. Now they have since then sold some of their assets, some of their non-performing assets, some of the Australian assets they sold for about $2 billion total. All these assets that clears up the debt that they have due through the next 2 years, through 2025. That is going to provide a big flexibility for MPW, for Medical Properties Trust, to be able to conserve cash, reposition their cash they need, and really, again, prop up these two tenants that are really the big question here. So really the big question is, are those two tenants? It's Steward and Prospect Medical, right? The big news Friday, why it dropped so much Friday is because the Wall Street Journal, is something I talked about in yesterday's market announcement, or market update, that the Wall Street Journal updated or reported that the state of California, a regulator there, had put on hold the deal that Medical Properties Trust had with Prospect there in California to take some equity in their payments group. Now, after the close there on Friday, Medical Properties Trust, MPW, was able to come out and say that, this was totally expected. They still expected approval of this deal, but it did hit the shares on Friday. But basically what we're talking about here, and the big overhang for MPW, are these two tenants, Steward and Prospect Medical. Okay, these are two hospital servicers that rent space, that real estate, those hospitals owned by Medical Properties Trust, right? That's the big questions, whether these two can survive. They are both, it seems, they're private companies, so they don't have to report financials. So it's kind of a black box we're looking at here. But it very much seems like these two companies are close to, if not insolvent or bankrupt, without support from MPW. Now, what MPW has been doing, really to the lamentation of all its investors, right? Is that it's been kind of propping them up, taking equity in those companies rather than writing off the rent that they owe them, the debt that they've been issuing, because Medical Properties Trust has been issuing debt, has been issuing loans to these two companies, really trying to support those two companies through the last few years. And we've talked about why that is, why they're performing so poorly over the last few years. It's across the hospital space, right? Across the healthcare space, we're seeing really a healthcare crisis in the United States. One, because through the pandemic, a lot of those higher margin, higher profitability services, those elective procedures, those other services were put on hold because of COVID, right? That really hit the hospitals hard. They've had a multi-year increase in costs in wages. Okay, there's a staffing shortage, especially among nurses, among doctors, some of those more technical jobs. That's driving those wages up and really hitting the bottom line for a lot of insurers or for a lot of hospital servicers. And three is the government's reimbursements, the reimbursement the government makes through programs like Medicare, Medicaid, and a lot of insurance companies. It just has not kept up with inflation. So we're seeing across the board, all hospital companies really over the last few years seeing a big hit to their profitability. A lot of companies, and that's why you see a lot of hospitals pulling out. They're pulling the clinics out from rural settings, pulling their hospital services out and back from a lot of places. So it's not just Steward or Prospect Medical, although there are some management mistakes at those two companies. Again, what MPW has been doing, instead of writing off the rent owed from those two companies that haven't been paying as much rent as they should, or paying back the loans that MPW has given them, it's taking equity positions in those companies. So it's really tightening that relationship with those two companies. What a lot of investors, myself included, would like to see rather is pulling back from that relationship, really cutting the dependence on those two hospitals, because those two hospital services, those two companies, are really a big portion of the revenue, of the rent collected for MPW, and that's why the stock has fallen so much, is because those two companies are such a critical part of the rent for MPW. So now, that's how it is. They are taking equity in those two companies in lieu of rent and debt. The cash savings, though, I believe the cash savings from that dividend cut, as well as just still very good operations for MPW. It is still collecting a lot of rent. Management was forecasting $1.60 in funds from operations for this year. Okay, so that is more than enough to cover even the old dividend, but it's much more. It's adjusted funds from operations payout ratio is like 60 or 40%, something like that, maybe 60%. So that it is much has more than it needs to cover the dividend, as well as continue to support these companies until they can recover, until basically that whole the healthcare industry and hospital industry recovers here in the United States. We are starting to see that. That's going to be one of the two catalysts, really, that you're going to have to wait for to see shares of MPW take off, right, and get to that $13 fair value where I believe it should be. One is that hospital servicers, the performance, the operational performance needs to improve. We've already started seeing that with some hospitals, some of the larger hospitals, especially the publicly traded ones. They have started to, after cost cutting, have started to turn their operational performance around and are reporting marginally better results. Right? Of course, it's still weighing on a lot of the other hospitals, but that is turning, and I believe that's going to be maybe another year before that really returns back to normal. The other catalyst here is just going to be interest rate cuts. Okay, we all saw what those interest rate increases did to real estate over the last year. Last year, real estate as a whole, the entire real estate sector fell 25%. Okay, that is the highest drop since 2008. Okay. Very rare that real estate falls that much, especially across the entire real estate property sector. So the fastest rate hike cycle in 40 years definitely had something to do with a lot of these real estate stocks, MPW especially, falling as much as it did. Now, obviously, the reverse of that, when we start seeing those interest rate cuts, right now it's projected going to be starting March, April of next year, the Fed is going to be able to start cutting those interest rates to help support the economy, bring rates down a little bit. And that is going to be a big catalyst for real estate stocks. Okay, on multiple levels, real estate really hits real estate stocks just because they're so leveraged, and because obviously because of the interest rates as an operational expense. So those are really the two catalysts that we're going to have to wait for with shares of MPW. The question is whether it can survive until it gets to that point. I believe with this dividend cut announced yesterday, the extra $350 million a year in cash flow that it's going to be saving from that, as well as just already the good free cash flow that it had before that even, will give it the financial flexibility it needs to survive. Okay. So that's why I went back into the market yesterday after that dividend cut announcement. I bought another 2,000 shares. Right now, I've got about 6,000 shares, cost basis of about $8.50. So I am underwater here, but collecting that dividend yield and just waiting out to the fair value for the stock. Want to talk about another one here, really talking a lot of news in the market right now, is a shadow banking in China really going to be the next Lehman moment. Okay, if you remember 2008, the Lehman Brothers implosion, right, was the big catalyst for that, that contagion across the rest of the financial space, and really the worst of the 2008 Great Financial Recession, right, Great Financial Crisis. And right now we're seeing in China the fears that a lot of these trust companies. So reading through this Wall Street Journal report, talked a lot about trust companies, right, and these are really shadow banking firms that make loans out. Okay, with the big warning here was just last week, Zhongkrong International Trust. It's a $108 billion trust company, failed to make its interest payments on 4 of its trust products. Okay. So the broader trust industry in China really, again, is kind of a non-financial lender, what they call a shadow lender, and it has over $2.9 trillion in assets. You see that here in this total assets for the trust industry. It peaked right around 26 trillion won, which is you divide that by about 7 for the dollar equivalent. It's come down a little bit. It's come down to about 21 trillion won right now. That's about $2.9 trillion in assets under management. That is basically all the loans, all the assets that these companies control or manage as loans, as investments. Okay, where they get this money, they collect it from individuals, from companies to invest, really try to make a profit off of that money by investing primarily in real estate. And that's really where the problem has been. With the real estate crash in China over the last 2 years, worries are that these trust companies, these private companies that don't report their financials, could already be bankrupt or really insolvent. Okay, a wipeout of those investments that it holds. A lot of those investors, whether they be corporate investors, individual investors, don't know really the extent of the of the pain here. But a bankruptcy of these trusts, a wipeout of those investments would flow through to those companies, to those investors, crashing the Chinese economy. Obviously, the Chinese economy, the second largest economy in the in the world. Would a crash of that economy would flow through, be contagion across the rest of the world. Now we are seeing the greater China benchmarks. So we have the GXC, which is the Spider S&P China ETF. That is down. That is down quite a bit. That is down 13% just over the last month. You can see here it peaked there, came back up to $81 there, July 31st. On ideas that the China government might be able to use some stimulus to really get that economy to grow again. That hasn't happened. China's economy just is not responding to this multiple rounds of government stimulus, from injecting money into the banks, lowering banks' reserve requirements, as well as lowering their interest rate. China's economy is still falling, and that's what the fear is, that that drop in the economy, that drop in the real estate is going to cause these trust companies to fail. That's going to crash the economy in China, and that's going to be contagion across the world. Okay, now one thing, China does have greater ability for stimulus right now than a lot of the other countries in the world, U.S., Europe, in general. Just because it's actually going through a deflationary moment, whereas inflation in the U.S. is still well above the Fed's target rate, right? So China doesn't have to worry about stimulating the economy too much and really stoking that inflation that can be a problem. China can continuously push money back out into the economy, stimulate the economy more, and try to kind of move past these asset problems and these asset bubbles. So that's why I think it might be more likely to be kind of a slow-moving train wreck rather than a full-blown dumpster fire. Okay, we're still going to see some pain until the China economy can really get back to cruising speed up there, right around 5, 6, 7%. We won't see that for probably another year here. So I would be cautious on China stocks. I'd probably avoid most China stocks. I do own shares of Alibaba just because I think there is some very strong investor sentiment catalysts coming for Alibaba. We all know that Alibaba is going to be split into 6 companies. It also has its subsidiary. It owns about a third of the Ant Financial company. That company is positioning, it's changing its documents and positioning for an IPO soon, within the next year. So Alibaba is going to benefit from not only that IPO, but also when it breaks apart the IPOs of these individual parts of the company. I believe that's going to be a very strong catalyst for investor sentiment for the company, as well as just operating performance. So that's why I own shares of Alibaba, but I would be avoiding other Chinese stocks just because of this economic problems. Last news item I want to talk about, then we'll get to question and answer here, is another Wall Street Journal article that I read. It was kind of interesting, kind of an interesting way to look at these weight loss drugs, this Ozempic and Mounjaro, that are coming out and really changing what we think about weight loss. Both of these drugs, Ozempic and Mounjaro, if I'm pronouncing that right, have been shown to be able to reduce body fat by 15% or more through trials. They're also through reducing appetite. They've also been shown to reduce the risk of heart attacks, diabetes, and strokes. Multiple FDA trials all the way through the process there. So it does seem like these are legit, and these are coming blockbuster drugs already. We can see they actually do show sales forecast for Eli Lilly's drug there, Mounjaro. Blockbuster drugs, forecasting Mounjaro sales alone to hit $20 billion a year by 2028, $20.74 billion a year. That is just ginormous. That is probably, if not the biggest, then probably the top 3 biggest, 1-year drug sales of any drug. So Definitely, and that's just that's just Mounjaro alone. You've got Ozempic as well as all the other drugs that are going to are being developed. I think Pfizer is trying to develop its own weight loss drug as well. Now, Eli Lilly, obviously, Novo Nordisk, the two companies that own these two drugs, have surged along with Weight Watchers. I've actually been talking about Weight Watchers for the last year here. My position in that is up 48% just in the past couple of months after they announced that they would start a program to include those drugs in their in their weight programs. But investors are got to be asking here, which other companies could see losses if these drugs become widely accepted or widely used? Right now I think we see forecast sales for 2023 for Mounjaro are still only 3.9 billion. If you take that to the forecasted $20 billion by 2028 over the next 5 years, that is definitely going to be a force that can change the greater market and the greater economy, not only through that drug and through that stock, but also the stocks that might get hit. One stock we're already hearing something about, Intuitive Surgical. They've already warned investors that their sales of medical devices like sleep apnea masks, as well as their bariatric surgery machine for ISRG here, Intuitive Surgical, might get hit. And shares have dropped 20% just since last month on that news, on that warning that these medical devices, again, any company that's making those medical devices, sleep apnea masks, bariatric surgeries, things like that, could definitely get hit if people are losing so much weight through these drugs rather than having to go through the surgery or something like that. Now, obviously, you want to make the distinction here between a company that maybe only makes these sleep apnea masks or only is connected with bariatric surgeries, and ones that are quite a bit more diversified. Something like a Medtronic, which is obviously quite a bit more diversified across different medical devices. We've also seen shares of Medifast dropping hard here. See if we can bring that up. Ticker MED. Medifast are down 26% since the beginning of the year, since really the news took off on those weight loss drugs. It's down something like 20% or so just this month, just since the end of July, when people really started worrying about what those drugs are going to do to some of these companies. That Medifast company, obviously, if people are losing weight from these drugs, they don't have to go on the Medifast diet and the programs and plans. The only thing keeping Weight Watchers up is that it has acquiesced basically and is starting to include those drugs in its programs. Hasn't really hit fast food companies like Krispy Kreme, McDonald's, things like that yet. Maybe it won't. Obviously, you've got kind of different up and downs on this. The drugs do reduce cravings; they reduce your appetite, so that might reduce some of those cravings for fast food and those fatty foods as well. But it's also going to let people gorge and not have to worry about diet. So you also have the idea that people might not care about watching their weight or they're watching their diet anymore if these miracle drugs are going to help them shed that weight, as well as reduce the risk of stroke and heart disease and things like that. So we'll kind of have to see how that comes out, but it might be a net negative for a lot of these companies associated with dieting, with obesity, and things like that. I want to turn it over here to the question and answer. Love connecting with you out there in the comments. I'm going to scroll up here to see what other comments we have, questions we have. If I don't see your question, please make sure you go ahead and answer it in the comment or in the chat, and make sure you use question marks so I see that it is a question. I'm going to start off. You didn't think selling cash security. Okay, Josh talking about MPW, I'm assuming here, says you didn't think about selling cash secured puts on it instead of buying. I generally don't use cash secured puts a lot of times for legging into my options trades, or legging into my stocks. That is one option. Obviously, selling a cash secured put, you can basically you just sell puts on it. If the stock continues to go further down, you lower your cost basis basically because you're going to pick those shares up. What I generally do instead, especially with stocks that have a high amount of volatility and that have fallen quite a bit here, then I'll sell covered calls against those stocks. So a covered call strategy instead. And it's really kind of 6 of one, half dozen of the other, right? They both come out to be basically about the same position, about the same return if you look at what the return options are. But just selling those premiums on the calls are pretty profitable, especially if you if you can go into those and sell them right after a big drop in the stock, or big volatility in the stock. So that's usually what I'll do, especially if I'm a little worried that the stock might fall further. With MPW though, I think it's really close to the bottom, if not at the bottom right now. So I don't know that I'm really ready to start selling those covered calls, really limiting my upside potential on those new shares yet until I see that it does start coming up a little bit. And then if it's $10 a share again, maybe I'll sell some covered calls against it at that point, just to lock in some of those profits and reduce that risk in there. But up until then, as I said, I think MPW is in a very good position here with that $350 million in extra cash savings it's going to have each year to apply and to survive through this period. Because again, I think there's less than a year before we start hitting interest rate cuts. That is going to be really the driver, the main catalyst for real estate stocks. That is going to really propel real estate valuations and the stocks behind them a lot higher. I think that's going to save, even if the hospital segment isn't fully cured, isn't fully recovered by that point. I think those interest rate cuts are really going to start propelling real estate stocks higher, and I want to be net long on that. But at that point. What else? See a lot of longtime members of the Bowtie Nation in here. Love seeing that. David from Rio Negro, Colombia. Hey, I was real close to my neck of the woods for a while there. Now in Tampa, but lived in Medellin for a long time. Sashward from Germany. Good to see you. Jordan, thank you so much for covering that. I was just part of okay. Jordan says he's getting scared on that MPW, and I think we all were. It's crazy. We were all loving MPW just a few weeks ago, right? It went up to like $10.60 a share. It was up something like 30-40% in just a couple of weeks, and I think a lot of that was as investors were watching it kind of seemingly disassociate itself a little bit from these two large tenants. It was starting to sell off some of its property. It had prospects sell off some of its hospitals and use that to pay down loans that it owed the company. It was cutting ties seemingly a little bit. Then in that second quarter report, we did see that no, it was strengthening the relationship a little bit. But either way, I think it's still in a very good fiscal position to be able to not only support those companies, but to be able to see operations through that. And it still owns some great properties. It owns 444 hospitals across 10 countries across the globe. It's the largest hospital owner in the United States, and it's not going to go away just like that. What else? We got some members there from Slovenia. Good to see you there. Daniel wants to know if I'm still invested in CCLD. Yes, I am. I still own shares of CCLD. I know it's been down quite a bit just lately. I'll have to put that's CareCloud. Put that on the list for Thursday. Thursday analysis, right? So I'll revisit CareCloud there on Thursday to see how it's doing, what any comments on why it's dropped, but up 8.5% today. So it's doing very well today, and even as the rest of the market is flat. So that's very positive that the stock is able to be up 8.5% today with the rest of the market doing so poorly. What else we have here? Hello from Prague. Two companies go back. Okay, so Jeff wants to know if the two companies, so the two tenants, Prospect and Stewart, if they go bankrupt, then we lose, don't we, as investors? Not necessarily. One of the things that I mentioned yesterday on the market update, talking about MPW, was there's really two questions that that you have to ask yourself as an investor for MPW. One, can it continue to support tenant and steward, until the hospital environment improves, right? Until their business improves. That's one question. The second question is, if one or both of those were to go bankrupt and were to be liquidated or whatever that would mean, then will it bring down MPW? So if the answer to either of those is, if the answer to either of those is yes, right? So if it either can support those until they both recover, or if if a failure of one or both will not bring down MPW, then it's a screaming buy at this point, right? 8.5%, 8.5% dividend yield even after the cut. Fair value, I believe, of about $13 a share, which would be almost 100% return from here. Then it's a very good buy. If, however, then you can answer no to either of those. So if it can't support the two companies, and if a failure of one of the two companies or both would bring down MPW, then it's going to be a value trap all the way down to zero. Again, I believe that we won't see that. I believe even if one of these two companies fails, I don't believe it's going to bring down MPW. Again, the largest hospital owner in the United States, 444 properties. I think they've got some very strong assets in this real estate, very much tangible real estate goods, tangible assets. So I don't think you really see a failure of MPW, even if one of these companies fails. Now, if both of them fail, I don't know. It's I think they're somewhere along the lines of 24% of rental income for MPW. So it would definitely be a hit that it would have to restructure around. And that's when you would see pain as an investor, whether it completely bankrupts MPW is doubtful, but it would definitely have to do some write downs on those. Okay. Also the merger. Can we talk? Okay. Slouger Polo. Sorry if I'm mispronouncing your name wrong there. Any opinion on IEP, Icon Enterprises? We've talked about IEP quite a bit in the past here. Carl Icahn, he should be setting off into the sunset. He's something like 76, 80 years old. And instead, he's being forced really to prop up his company and to protect his legacy as really an amazing investor. One of my favorite books is about the history of the United States in 5 stock market crashes. It's Scott Nations wrote it. He's a contributor there on CNBC. Great book, excellent book to understand the different crashes. And in one of those crashes, he really talks about, I think it's the 2008 crash. He talks about, the Black Monday crash, 1989. He talks about Icon's start as a corporate raider, as an activist investor, and just some amazing deals that Icon has put together over this, more than 60, 70 years that he's been investing. So my thing about IEP, Icon Enterprises, is really most retail investors have no way of getting into that kind of activist hedge fund private equity stratosphere or sphere, right? Because of SEC rules for accredited investors. Then unless you have $1 million net worth, which is completely ridiculous, then you can't invest in a lot of those alternative investments. Well, what you're able to do through Icon Enterprises is invest alongside Carl Icahn, one of the best activist investors in the world. So I like it. I like it on that. Obviously, there have been some missteps here over the last year as far as paying out more dividend than they really should have. No company should be paying out a dividend of 15, 20% and think it's sustainable. Okay, it's very, very difficult to do. I don't know anybody that could do that, over the long term and have that kind of a sustainable dividend. So they cut the dividend back. Shares sank in commiseration with that. And I think it's a good investment right now. Good opportunity to invest alongside an activist investor, but also a good opportunity for return on that stock as well. Okay, thank you for addressing news. Long-term path. What else here we have? What do you think of signifies? What do you think for that signifies? Okay, so Tony sounds like he's. What do you think for that signifies the bottom in MPW? I'm not quite sure what you're asking there. Obviously, I think really again the bottom for MPW is going to be knowing that the hospital industry has turned the corner. That those hospital services or hospital facilities are profitable or are more profitable than they've been. Okay, that's going to prop up the operating performance of those two largest tenants, that Steward and Prospect Medical. Obviously, that's going to mean debt payments. That's going to mean equity payments. That's going to mean rent payments from those two companies to MPW, as well as some kind of an idea of when the Fed can start cutting interest rates. I think that's going to be the big thing for real estate in general, but also for medical properties trust. What else here? I accidentally scrolled down too far and lost a lot of these comments. Where are we here? Okay. Still bullish on TDOC. Yes, I still own shares of TDOC. Obviously, that's Teladoc Health. Obviously, it's been one of the frustrating growth stocks that we've been in. That and PayPal have really been the only growth stocks that we've been in that have really frustrated with that slow growth. Really, coming off those ideas. Teladoc is still forecasting about 9% sales growth each year. I do believe that comes back, does a little bit better. Once we get into a little bit more of an environment that's good for them. Something what I've been talking about with Teladoc and a lot of these growth stocks is you look for an industry that is growing, an industry in demand. I believe virtual healthcare is really, going to be a growth industry because if you look at healthcare costs and the costs that can be cut, the costs that can be cut, minimized through virtual healthcare, it's just a no-brainer. We're going to get to a point where people just can't afford their healthcare, can't afford the doctor visits, can't afford a lot of that. And so virtual healthcare is going to be a thing that we're going to gradually move into. Obviously, it's not going to be to the point that we saw in the pandemic where you had to use virtual healthcare, but it is going to be more of an alternative, and one that a lot of insurance companies, I think, are going to be forcing on people. As those healthcare costs go up, insurance companies have that vested interest in saying, hey, you know what? If you can make that visit virtually at a lower cost, then you do that. I think that's going to help Teladoc. I think obviously it's going to help the whole virtual healthcare space. Teladoc, why I'm in Teladoc specifically, is they dominate that space. Even with entrants like Amazon has got their own their acquisition that they made earlier in the year. Even with other virtual telehealth companies, Teladoc still dominates that space and is going to be the prime beneficiary, I think, of that growth. So that's why I'm in Teladoc. Yes, it's been frustrating that it hasn't taken off like some of these others, like SoFi that we've been in for a while, but I do think it's going on. It's going to do very well. Strong at the Rim wants to know what's going on with Amazon. Haven't really looked at Amazon very much. I do actually own shares of Amazon. It's not a big position, but it is. I do own shares of that. I haven't really looked at where it's at right now. Amazon's going to run the world. Okay, there are things Amazon is doing that we don't even see. It's investments, it's in equity investments in other companies, but just the core business, I think, is a reason to own Amazon. Okay, if you look at their Prime service, their delivery service, all the little parts of Amazon that I do think eventually they will be forced by the government to split up because Amazon is just going to touch every facet of our lives. The government is going to be worried about some kind of a monopoly situation like Ma Bell was back in the 80s. I do believe Amazon will be forced to split up, and I think the sum of its parts are greater than what the stock is trading at right now. Okay. We've already seen analysis like that from I think Dan Loeb was the one that raised that issue about a year ago, that if you spun off the cloud services division from that e-commerce division, I think the sum valuation of those two would be greater than the stock price right now. So I think that's a one reason, and a very good one, to buy shares of Amazon. Okay, just thinking around. How long would that be, in your opinion? December for the bottom. Okay, so Jordan wants to know how long would that be for bottom. I'm assuming for MPW. If we're again, I'm not going to call a bottom for MPW for any stock. I think it is very close to where we're at right now, if not in with the bottom. But we do have to wait for those catalysts. And folks, I know everybody wants to get rich in the next month and quit their job in the next month, but you have to take a long-term view of these. I think MPW, if it gets to that $13 fair value, even if it takes 2 or 3 or 4 years, even, I mean, doubling your money in 2 or 3 or 4 years is still an amazing return, 25% annualized return, along with the 8.5% dividend yield you're collecting on the current price. So even 3 to 5 year time horizon on that stock would be an excellent return. You just have to understand, okay, does it have that survivability? I think it does. And what are those two catalysts that need to come along, and what's kind of a time frame for those? Okay, we know we're getting interest rate cuts here probably within the next year and a half at most. Market's expecting interest rate cuts to start here in here as soon as March of next year. That might get pushed back a little bit if inflation is still a little bit higher than the Fed's target. We're going to hear Fed Chair Powell on Friday talking about that. But even at the latest, I think, maybe a year at the latest, we start seeing those interest rate cuts from the Fed. That is going to be the first big catalyst that's going to support real estate stocks and MPW. So I think at the most you have to wait, upwards of about a year to start seeing those shares really take off. We'll start seeing in that time as well, start seeing those hospital operations continue to improve, and I think support the stock as well. Okay. Sounds weird. So my son there is saying my microphone sounds weird. Let me know if my mic sounds a little weird. It might be. I figured out that it's recording my new OBS software is recording at 60 frames per second, which is definitely not something we need. So I'm going to adjust that down to 30 frames per second. Hopefully that'll change the recording as far as some of the lags and stuff like that we have. What else? Tell me more about good dividend stocks. I'll put dividend stocks on Thursday's live stream for you there, Pedro. Kind of have to go back into those. First account, would you consider ADEN a buy now? Down 45% since last week. I think it should drop another 15% if I do my calculations, but it was very expensive. It still started this month. ADEN, it has been struggling, obviously 45% since last week. That's one of those things that you really have to dig deep into it. I know a lot of investors, they go after these value stocks or these deep discount stocks, and they think, just because it falls 45% in a week or a couple of weeks, then it must be a good value now. Well, you really have to, at that point, you really have to dig into what other people are saying and dig into that bearish side of the argument. It can be very easy to look at a stock, do a quick cursory look, think that, okay, if it goes back up to just the price it was over the last couple of weeks, that's 100% return. If it drops by 50% and then builds back up to that point, that's 100% return. So it can be very easy to get dollar signs in your eyes and think that it's got to be a good investment, right? And then what you do when you're looking at analysis, you tend to kind of disregard a lot of the negative analysis. It's called that confirmation bias, where you're really only looking for the positive view or the view that really aligns with your own perspective. So you really have to make it a conscious point to look for the analysis that says what's wrong with the stock or goes against what your perspective is. Really give it the time of day. Really understand why people are selling it off. What the trend is for ADEN, for a advertising online advertising marketer there. I would want to know, okay, where's that market share going? If it's losing market share, which I think I didn't read the full commentary in its earnings, but I think it's losing ad share or ad market share to some of these other online companies, right? So I would want to see, where that market share is going to, why it's going to those other companies, and you might actually find out that you want to invest in these other companies, these competitors to ADEN instead. If they're able to pick up that market share of that industry, because obviously they may have some kind of competitive advantage if they're able to pick up that market share. Thoughts on Vici? Manuel says haven't really covered Vici, so I'd have to look into that, but I can't really give you any kind of a comment yet. Yep. And Adjury says I'm getting trolled by my son again. Yep, he's here on the live stream. Johnson & Johnson's the only medical company I have long term. So Vape King says he has Johnson & Johnson as a medical company. Obviously, Johnson & Johnson, talking about those medical companies that could be hit by those weight loss drugs. I think obviously Johnson & Johnson is one of those that is diversified enough that even a hit to those segments that will be affected by the weight loss drugs aren't going to be material to the stock. What are your thoughts on Foot Locker? Retail is tough, man. Retail, I've only, over the past 5-10 years, I've only ever invested in retail as kind of a very short-term rebound play, okay? Because, e-commerce is just eating retail's lunch. So it has to be a company that has a very strong e-commerce side to its sales. I don't believe Foot Locker really has that just yet. Foot Locker is still very much dependent on those malls and on that foot traffic, and I think that's why you see very very much volatile sales in their quarter to quarter sales and that kind of thing. So again, Foot Locker, I think it had a very bad. What did it do? I think it reported sales just recently, right? Or is about to. I mean, it's down 3.2. It's about down about 8% this week. And when does it report? Okay, it actually reports. It reports tomorrow, so that's probably why you're asking. It reports. Reports tomorrow, so after the close today or before market open tomorrow, it's going to report its third quarter sales, and that's obviously not something that I could call just on a quick analysis. You really have to be following it. I think there's obviously a reason why it's down 8% so far this week. I think we've got a lot of bad news from retailers this week. I did see that Dick's Sporting Goods was down something like 24% on what I believe is an excuse of higher thefts. Now, obviously, theft and inventory shrinkage, as they call it, has been up over the last year, but it doesn't seem like it should be quite as material of a factor to drive sales down that much. They missed earnings by like $1 a share, something like a 20% miss on their earnings per share. So I think there's something else there that Dick's Sporting Goods is not talking about that is really hurting their operational performance. I think people are worried. Here Foot Locker is down 4.6% today. I think people are worried that they're going to say something like that as well. That they're, right or wrong, they're going to blame whatever operating performance they have on theft, on inventory shrinkage, and try to hide poor management or poor operating performance that way. So I would, obviously, it could jump higher. On earnings, there's always a possibility. I would avoid it though, because it could also fall quite a bit further. And I just like not losing money. Okay, I can miss out on some of the big winners of the day as long as I don't lose money and eat up some of the gains that I've enjoyed. I'm not. Your thoughts on that? Okay, so Beyond Travel. Beyond Travel wants to know thoughts on FDX and UPS, especially if they can keep up current dividend growth rates. So obviously very good growth rates in their dividends, 31% and 17%. Those are nice growth rates for both of them. I really, I really worry about the state of their contracts with their drivers. I don't know. I don't know for sure. I haven't looked at either of those companies, whether they have unionized drivers through Teamsters or a different union. But right now, I mean, the union drivers, truck drivers, and whatnot, are just eating any logistics companies for dinner. Okay, we've already seen the Teamsters bankrupt. The Yellow company is 100-plus-year-old trucking company bankrupted because wages were just going too high, wages and benefits. I think I saw the big viral news story over the past couple of weeks is that UPS drivers are now making $170,000 a year with pay and benefits. So obviously, I mean, obviously there's other expenses and it's not all on the drivers and that kind of thing. But it's very hard to be profitable if you're paying your drivers $170,000 a year on pay and benefits. The unions right now under this administration have a lot of power, and they're rightly so in some cases. But they have a lot of power right now, and they're using that power as leverage to get higher wage concessions, higher benefits, and that. So I would be worried about FDX and UPS under those terms. Just under the idea that the wages, and especially driver wages, are a big chunk of their operating costs, and those are there's no end in sight of how high those wages are going to go right now. Jerry wants to know what are your thoughts on ARK K? So that's the main ARK fund, Cathie Wood's ARK fund. There, I think it's been struggling this year, hasn't really rebounded along with the rest. So we'll look at that. The ARK Innovation ETF, and we've talked about this quite a bit on the channel. I'm not a fan. I do like some of the stocks she's holding in that. So I mean, if we look at here, we compare that to the NASDAQ. We'll just compare performance of the ARK Innovation Fund against the NASDAQ over the last, we'll do year to date. So it is pretty well performed, about in line with those top 100 stocks in the NASDAQ, those technology stocks, right? Go over 1 year. So 1 year it has underperformed quite a bit, down 8% versus the NASDAQ, which is up 6%. Go further out 5 years. 5 years and it is way underperforming. Obviously, we saw a huge spike there in the ARK, in those growth stocks there in 2021 when Cathie Wood, everybody was worshiping to the cult of Cathie Wood there, and she did well. She was early to that party, and she did very well during that. But I think we can see what happened here. Now, again, I do like some of the picks she has, and I do own some of the stocks she has in that. If you ever want to see what is in an ETF and some of the stocks that they're holding, you can go here to Yahoo Finance, go to the holdings. It's going to show you the top 10, or if you want to see the full list, you just look for the ARK Innovation. We go to ARK Invest. If you ever want to see the full list, you just go to an ETF's website. We'll find the ARK Innovation Fund here. I think it's this disruptive innovation here. Accept. And then on that, we go explore ETF. They will have a holdings tab on any ETF that's publicly traded. They have to have on their website their holdings, so you can see this, and you can scroll down and they'll show you the top 10 here, or you can download this full holdings PDF. Okay, see if it brings it up here. A PDF or Excel file, and you can see all the investments they have in there. And again, I do like some of the stocks they own. I own some of these stocks. I own UiPath. I own DraftKings. DraftKings has been a huge return for me over the last year. I think it's up something like 120% or something. I own Unity Software. I own Teladoc there. I own. Let's see what else they have. That I have. I think that might be it. I have owned Palantir when it was a little bit cheaper. I've owned Meta, over the last year, but sold that recently. So they do. I own Invitae. Okay, so they do have some good growth stocks, and it's a smart strategy to play. Okay, those growth and those companies that are disrupting the way we do things and really changing the way we do things. What I don't like about Cathie Wood's funds and the ARK Innovation ETF, any of the funds here, is really how they're managed. And some of that is just a factor of how they have to manage them. According to redemptions, they need to sell some stuff to make cash available. Maybe they try to go a little bit more into one particular stock, so they have to sell some others. But if you look at really what's happened over the last year and why it's underperformed the NASDAQ by so much over the last 2 or 3 years, is because they have sold a lot of their stocks, and just really missed out on any kind of a rebound. They've sold out on stocks like what did they sell? It was weird there for a little while. It was almost you could almost time your watch to it. ARK, you'd see the news story that ARK Invest had sold out of their position or sold a big chunk of their position, and then 2 or 3 days later, the stock would just take off. So they really missed the boat on a lot of stocks that they had held for a long time, had taken a loss in, gave up on, and then that really signified the bottom for that stock. They missed it on Virgin Galactic. They've missed it on. I think they were in. They've sold out of what were some of those? I can't remember some of them. Some I think it was Coinbase. They sold out of a big position in that, and it went up, and they've since went back into Coinbase on that. A lot of the stocks, though, they just don't. I just don't think they manage it, and they certainly don't manage it for the long term. Okay, with these growth stocks, you have got to be in it for the long term, because these near term catalysts like rising interest rates, like for one missed earnings release, something like that can really send the stock down. You can't trade in and out of it and trade into those losses. You can't take those losses. You got to hold on to them for the long term. Ask anybody that's been in shares of Tesla over the last 10 years or so. There have been times when they really questioned that investment because, those shares of Tesla were down, 30, 40, 70% sometimes. But, if they had held on for that 10-year period, it's a factor of 20 or 30 times their money at this point. So you have to be in them for that long term. I just don't think that Kathy Wood and her team at ARK are really managing that fund and its holdings for that long term. They're selling out a lot of stuff in the short term, and I think it's really hurting it's why it's underperformed quite a bit. Favorite bank stocks. Saw somebody asked that there. Favorite bank stocks. One is, right now, SoFi. SoFi is my one and only favorite bank stocks. I do still think that, you've got the traditional banks, especially the larger ones. You've got banks like Citigroup, Bank of America, the larger banks. JP Morgan obviously always does very well. You've got those that have the financial capital to really, get through this environment right now. Really, what's hurting the banks right now is the inverted yield curve. Okay, so they are paying normally in a normal economy, long-term rates are much higher than those short-term rates. Okay, so you could borrow money. On 2-year terms or 1-year terms at 1 or 2%. If you're borrowing money through a mortgage, it's going to be 5, 6, or 7% or whatever. Okay, so it's a sloping yield curve like this, and how that benefits the banks obviously is because they take your money in as deposits, they save your money for you, and they pay you almost next to nothing, right? If those short-term rates, those rates on T-bills are very low, they pay you next to nothing on those deposits for your interest. They take your money and lend it out at those long-term rates, right? Those 15 and 30-year mortgages, and make a lot of money on that difference, on that spread. Well, right now, because those long-term rates are so much lower, even with the rise in interest rates, the 10-year Treasury right now is right about 4.3%, and the short-term rates, that two-year Treasury is just over 5%. Right? So it's actually inverted. So those short-term rates are higher than the long-term rates. What's that doing to banks? They're actually having to offer higher interest rates on their deposits. Okay, we're seeing some money market funds offer 4.5%, 5% on the money you have in there. Savings rates are coming up as well. Banks are having to pay their depositors more money, and they're not getting that much off of their mortgages. Banks, I think the average mortgage hit 7%. Just over this last week, which is obviously above that money market 5% rate and stuff like that, but that spread is just not enough. So banks are really having trouble with that profitability right now. Eventually we will get through this. Every short-term economic fluctuation changes to the next, and we will get through back to where it's a normal yield curve, and the banks are going to make money. Okay, the banks are putting a lot of money away in their loan loss provisions just in case we do get a recession. If we don't get a recession, they're going to have a lot of cash to be able to bring back onto the income statements. Going to make a lot of money. So I think a lot of those bigger banks that don't have a problem, those are going to do well. So your very good values in Citigroup, in Goldman Sachs, I think is at a valuation lower than we've seen it in many years. Goldman Sachs is going to do well. JP Morgan, but really SoFi is the bank that I've got the most money in. I think it's probably my largest position right now. I got about $200,000 in shares of SoFi, and have really starting to ride that one all the way up, and I'll continue to do so on that. So yeah, still getting some more comments that my mic sounds distorted. I'm gonna have to look into that. I got a new computer just over this last week, so the settings changed and things like that. I'm gonna have to check that out. I know the sound was a little odd, a little off on the Monday market update as well. Okay, what else? What are your thoughts on Endeavor? Haven't covered Endeavor. They own UFC and WWE. Okay, so Endeavor, ticker EDR, owns the UFC and the WWE, I guess. I've never been, well, I guess since I was like 12 or 14, haven't been a big wrestling fan. So I haven't really looked into the operating performance of either of those companies, really the demand. I know WWE has been very popular over the last 5 or 6 years. Been doing very well. They're supposed to merge and make TKO Holdings. I don't know. I'd have to look into that a little bit more for you there. What else? What's on SCHD? Manuel wants to know about SCHD. That's the Schwab dividend income fund, dividend growth fund. SCHD, we can look it up here. SCHD. U.S. Dividend Equity ETF. It's one of the big dividend funds we've covered quite a bit on the channel. I really do like this fund. I've liked it for quite a while. It's obviously not going to make you rich. You got the 1 year. It's just a little underwater over the last year. Last 5 years, it's provided a pretty attractive return there, plus the 3.5% dividend yield. So this is one of those funds that you can basically kind of set it and forget it. Okay, we've got $73 now, 5 years, 53. So it's actually come up, it's come up probably about, I mean, that's pretty good. That's a pretty good 30-40% in price appreciation along with that yield. Obviously, it's not something that's probably going to be able to continue to do forever. It looks like it kind of tapped out here over the last 2 years. Probably ran into valuation there a little bit. But this is a solid fund, for dividends, for price appreciation, and one I think you can count on, right? This isn't one of those dividend funds like the QYLD or the some of those income funds that are gonna hurt you on the price side. Uh, so definitely one I would look at if you want kind of a non-stress investment there. Daniel wants to know about Macy's. Macy's, I know, is reporting. If not, didn't report today, but it reported after the bell. Uh, what do we got? Nope, it reported today. Obviously, Macy's reported today, and again, a lot of stress there in the retail side. Macy's down 14% today. I know, again, Dick's Sporting Goods was down 24%. We're seeing weakness across the retail space. Kohl's down 10%, Nordstrom down 9.7%, and a lot of it is, one, the worries, the fears over theft, over that inventory shrinkage, as they're calling it again, but also just the general inflation in wages. The jobs market is very tough for those lower income jobs, I guess you could say, and trying to fill those jobs. So I would be worried about retail right here, especially going into what could be a challenging few quarters for consumers. Okay. Consumers are really kind of tapped out as far as with their debt. We are seeing credit card balances rise. We're starting to see, obviously, those interest rates on those credit cards are going up and really further stressing out consumers' ability. We're about to start seeing the student loans. We're about to start seeing the student loans come back to paying, and that's going to hit. It's going to hit consumers pretty hard, I think, over the next few months. So I think that's what a lot of investors are watching for in these retail stocks: really a weakening consumer and just not a great environment for the economy or the consumer. And so that's why outlooks are getting worse here for retailers. I don't like QLD. Nope. I do not like the QLD. I think there's much, much better options than QLD. If you want one of those income funds, I'd go with the JEPI. You've got a great team of management there with JP Morgan. Has done very well on the price side and has continued to pay out those dividends. So again, if you want those higher income funds, I'd go with JEPI. Now, understand any of those covered call strategy funds, those income funds, QLD, RYSI, I think it is, the JEPI, those are taxed. Those dividends are taxed as income. So you are going to be paying a higher tax rate on those rather than a lot of your dividend stocks that'll be qualified dividends, and you won't have to pay quite as much. EM hydrogen car they've been pushing. Quags wants to know about Toyota hydrogen car they've been pushing. I've seen it on the road in the area of fuel stations now. So yeah, this is. I mean, that's an interesting development from Toyota. I know they've been pushing it. I haven't really read a whole lot about it. This hydrogen car from Toyota. I know they also have. They've also got their own electric models that could be doing well. For something like this, I mean, you see, when I see this big jump, so 142 up to 165, just in the last few months, I always start looking at valuations, right? What is the price to sales on this compared to other stocks? We see it's trading for about 0.82 times on a price to sales. That doesn't look especially expensive, given its history. Here we see last year trading for 0.81, 0.93. So it doesn't seem especially expensive given its sales. I know Ford and Motor trade quite a bit below that, but then they don't have quite the operational performance, or the financial performance as Toyota either. So here we do see 0.28 times price to sales for Ford, right around 0.3 times seems to be the average for that company. Again, I haven't read a whole lot about the hydrogen technology they're pushing in their cars right now, but if they've already got fuel stations for it, if it's already a proven technology, then it might be. Obviously, it's much cheaper than shares of Tesla, for NIO, for Rivian, for a lot of the purely electric car companies. So if that's going to be a proven technology that is going to be a lower cost of ownership and something that's going to take off, then it might be time to start buying shares of Toyota and giving it a chance. I think at worst, you're getting a stock that is probably trading right around fair value right now anyway. So at worst, you're probably not going to lose a lot of money on it. You're probably going to be, maybe it'll be dead money and you'll collect that dividend. But at best, hell, if that becomes the next big thing, that technology, then you're going to make a lot of money on that. So I think it's probably a good risk reward trade off there for Toyota. Okay, Alex wants to know about FRBK. It's a stock we were in. We were in for quite a while. It's one that we've sold out quite a few months ago, though. That's one of the problems with running a YouTube channel like this, instead of the traditional equity management or portfolio management where I used to work. Is as an equity manager, as a portfolio manager, then you're basically managing other people's assets. You change their stock positions when you changed your opinion on them. For something like what we have here with a stock channel, I could change the position I have on a stock, or sell my own position. And if you don't see that video, then I'm sorry, you're kind of SOL. It kind of sucks. And here we see, First Republic down 55% today. I know it's fallen quite a bit here over the last couple of months. We were actually, so I started talking about it here right after the big banking crisis. I was in it. I lowered my cost basis down to about 89 cents a share. I was in it right around $1.27. Then I dollar costed average down all the way down to the bottom here, about 70 cents a share. Ended up selling out $1.26. So I didn't hit the peak there at $1.53, but I did pretty well over about a 3-month period. But we did start selling it. Obviously, there were some other operational problems with the company. A big fight over a controlling interest in the company and some other interests in there. And of course, the short sellers were attacking it quite a bit. So I wanted to take a quick return in that company and get out, and did a couple of videos on it. Obviously, with YouTube being as it is, doesn't send those videos out to everyone. So it's kind of why I always suggest, okay, hey, tap that bell notification so when videos are coming out, and you can at least kind of scan the video to see if it's talking about any of the stocks that you own. Sorry if you're still in that stock. I do think, after 55% down today, as well as just the drop that it's been in since that May peak, it might be time to just take what you can get out of it and put it in a better stock, because obviously there are some real problems in that stock. It's fallen to a market cap of just $21 million. So I would think twice about pushing more money into that, or even holding on to it at this point. Okay. What else do we have here? Joe, do you live in Argentina? No, I live in Tampa, Florida. Lived in Medellin, Colombia for about 9 years. Just moved here last year, or 2 years, year and a half ago, to Tampa. And it's coming up on more than an hour in this live stream. I'm going to have to cut it off here because I got to get to CrossFit. But just make sure you get that free 5-minute stock analysis guide there in the chat. I'll also put the link in the comments there real quick. What you need to know to be able to analyze any stock. It's going to get you started. Make sure you're on the right track there. Click on the video here. I'm going to post here for 7 free investing tools that I use every week. A lot of you are going to recognize these tools because I use them in our market update every Monday. but a lot of them I use for research in the background. Great investing tools to see that big picture idea as well as analyze individual stocks. So go ahead and click on that, and don't forget to join the community so you don't miss any videos.